Greetings. Welcome to President Akome's tutorials. In our today's tutorial, we'll be looking at IS2 inventories. IS2 provides guidance on the accounting treatment of inventories. The following fall under the scope of IS2: calculation of costs of inventory, recognition of this cost as expense, recognition of other expenses associated with inventory. IS2 applies to all assets that meet the definition of inventory, except for financial instruments, biological assets related to agricultural activity. The following items should be excluded only from the measurement. Items like mining, forestry, and agricultural industry, provided that well-established practice exists in those industries to measure goods at net realizable value at certain stages of production. Commodity broker traders who measure their inventory at fair value less cost to sell, with changes recognized in profit or loss. Okay. Now, as per IS2, inventory is an asset held for sale in the ordinary course of business, what we normally know as merchandise. And in the process of production, for sale, what we normally know as work in progress, in the form of materials or supplies to be consumed in the production process or in the rendering of services, what we normally know as raw materials and consumables. So in simple terms, inventory is an asset that the business holds for sale, normally what we refer to as finished good. Okay, and also in the process of production, what we refer to as work in progress, and lastly, what we refer to as raw materials. That is what inventory is. So IS2 still guiding us at spare parts expected to be used for one accounting period or less are regarded as inventory. Major parts expected to be used for more than one period are regarded as PPE. So intangible assets can also be inventory, such as computer software developed for resale or unbilled work of a service provider. Okay. Recognition and derecognition of inventory. IS2 does not prescribe the recognition criteria of inventory. So the definition of an asset in accordance with the conceptual framework is then used. Okay, so inventory should be recognized as an asset where the definition and the recognition as the conceptual framework are met. That is to say now that in order for us to say that or to recognize inventory as an asset, it must fully meet the definition and the recognition of an asset as per the conceptual framework, which is a present economic resource that should be controlled by the entity as a result of a past event, and very important, should be relevant and faithful representation. So recognize as an inventory asset when it meets the definition of inventory. Okay, so that is now we recognize inventory as an asset when it meets first the definition of inventory, and then it also meets the definition and recognition of an asset as per the conceptual framework. We then have to recognize an inventory asset. Recognize inventory on the date when risks and rewards of ownership, when ownership transfer to the entity, usually delivery date, and all that. Okay, so very important. We recognize inventory on the date when the rewards and risks transfer from where the business is buying this inventory from to the entity. On that day, then we recognize inventory. Okay, so we recognize inventory on that day. On deal recognition, recognize carrying amount as expense. Now, on deal recognition, which is when we remove the inventory from the books. Okay, to deal recognize inventory, then first what we need to do is that we should recognize the carrying amount as expense, part of costs of sales. Okay, so deal recognition and revenue recognition should coincide. Okay, so all right, very important. We must know the measurement. So inventory is initially measured at cost, which then includes the cost of purchase, how much this inventory is being bought from the supplier. That is the cost of purchase. If there's some other factors, which are the factors now look at, then we have to take those factors into consideration. And very important, this cost also includes conversion cost, which is the cost incurred to convert raw materials into finished goods. Other costs incurred in bringing inventory to its present location and condition. So all of those costs then form part of the initial cost. Okay, that is to say now that inventory is initially measured at cost, which includes the total cost of purchase, conversion costs, and other costs incurred in bringing inventory to its present location and condition. Now we speak of the payment on the transport of that inventory, site cost. So site cost will then be capitalized the initial cost of inventory. Subsequently, then inventory should be measured at law of cost and net realizable value. That is subsequently, after the inventory has been recorded in the books, now in the subsequent years, we won't be measuring this inventory at cost anymore. Purchase cost comprised of the purchase price, like we mentioned, which includes the import duties, non-recoverable purchase taxes, which means if there's any recoverable purchase taxes, then we don't include it in the purchase price. And very important, transport and handling costs. Remember, as per IS2, the costs that are directly attributable in bringing this inventory to its present location and condition should form part of the initial cost. So that is now where we have the transport, handling costs, and any other costs that are directly attributable to the acquisition of raw materials, merchandise, and consumables. Okay, so VAT can only form part of the cost of inventory when the entity is not VAT registered as a vendor for VAT purposes. Now, IS2 guiding us that in order for VAT to form part of the initial cost or to form part of the purchase price, it should only happen that way if the business is not registered as a VAT vendor. That means that if an entity is registered as a VAT vendor, then that VAT, we don't have to include it as inventory, or we don't have to include it as part of the cost of inventory. Now, if we look at this scenario here, let's say we have an amount of, or the business paid an amount of 115, including VAT, to purchase this inventory. Now, when you come in the books of the business, this inventory should be then recognized at this cost of $100. It shouldn't be recognized at the cost of 115 because the other 15 is VAT, and this business is a VAT vendor. Therefore, we don't have to recognize that 15 as part of the cost. We don't capitalize it as part of the cost. We only have to capitalize $100. Trade discounts or cash discounts are deducted from the cost of inventories. Now, if a business purchases inventory and then it receives discounts, then those discounts should not form part of the cost of inventory. Settlement discounts should be estimated at date of purchase and deducted from the cost if intended to be settled within the time. Okay, if there's any settlement discount when the purchase of inventory took place, then this business was granted or was promised to be granted a settlement discount if they will have to pay the accounts on time, then that cost at the date of purchase, it should be estimated, or those discounts at the date of purchase should be estimated and then deducted from the cost of inventory. Okay, so rebates. So representing refund of part of the purchase price should be estimated at the date of purchase of inventory and deducted from the cost of inventory. Okay, if there's any rebates on the date of purchase, which is a refund of part of the purchase price, so those rebates should be estimated and should be deducted from the cost of inventory on the date of purchase. Okay, so very important. If it's against the purchase cost, then this rebate will obviously reduce the cost of inventory. But if it's against the selling cost, then it won't reduce the cost of inventory. So credit income. So let us look at an example. So example 1, we're told that X Limited, very important in brackets, we are given that this business is a VAT vendor, which means that each VAT doesn't form part of the cost of inventory. So in other words, they can refund their VAT on purchase. Buys inventory for $115,000, VAT inclusive, and pays cash in order to make use of a 15% cash discount offered by the supplier. The inventory is transferred to X Ltd's premises by train, and the total relays amounts to $50, VAT exclusive, cost incurred to secure the inventory, while instead amounts to $90, VAT exclusive. Now the question is, what is the cost of purchase of inventory? In other words, what is the initial cost of this inventory? Now, as per IS2, inventory should be measured at the purchase price, or the initial cost should, the initial cost should comprise of the purchase price, the conversion cost, and any other cost that is directly attributable in bringing this inventory to its present location and condition. Now, if you look at, in this example, X Limited bought this inventory for this amount. So the purchase price for this inventory was this amount. So the HL paid this amount, but now this amount will also be affected by factors like VAT and the discount, because this inventory, yes, costed this amount, or this was the amount for this inventory. But now, since X Limited is a VAT vendor, which means that they can refund their VAT. Therefore, we must calculate out that VAT and then remove it from the purchase price. That is to say now that that VAT should not form as part of the cost of inventory being guided by IS2. And also, we need to take the 5% cash discount into consideration. So to do that, then, can adjust our purchase price, multiplied by 100 over 15, then remove out that VAT. That is 100,000. So the purchase price, VAT exclusive, then that is 100,000. But now, should we capitalize this, the cost of inventory? No, simply because we still need to calculate this 5% cash discount that was offered to X Ltd. So why are we doing that? We are doing this simply because X Ltd won't pay this 5% cash discount. Therefore, as per IS2, it should be, or it should not, yes, it should not be part of the cost of inventory. Therefore, we must remove that 5% as well. Remove the 5%. Must calculate the 5%, and then we remove it. Okay, let's do it this way. So in the 100,000, calculate a 5% discount. So we'll get that the discount is 5,000. 5,000 is the discount. Okay, so that 5,000, we'll then have to remove it from the 100,000. Then we'll get that the purchase price will then be 95,000. Okay, so what we did to get the purchase price, that will form part of the initial cost of this inventory. We took the extra cost, which is 115,000. And since this business is a VAT vendor, which means that it can refund its VAT. So we had to calculate that VAT out and removed it and the balance on 100,000. But since X Ltd was given a discount, now SPIS 2 cash discount should not form part of the cost of inventory. Therefore, you need to calculate out the discount, which is what we got as 5,000, and took the 100,000 less the 5,000, and 95,000 is the purchase price. Okay, now let us capitalize any cost that is directly attributable in bringing this inventory in its present location and condition. That's when now we have cost like release. So since this inventory was brought to the premises of XLDD by train, then the cost they spent on that should also form part of the initial cost of inventory as per IS2. That is 50. You can see there is no VAT included in the 50. And also, there should also be insurance. Okay, they spent 90. So in total, the initial cost of this inventory will then be 95 plus 50 plus 90. That then should be $95,140. So that is to say now that in this example, this inventory will be measured at a cost of 95,140. Okay. Example 2, A Ltd recently incorporated and registered for VAT. So that is to say now that VAT, A Ltd is a VAT vendor. So always bear that in mind, which means that their VAT won't form part of the initial cost of inventory. Or in other words, it won't be capitalized as part of inventory. A Ltd purchase goods from a supplier who wants to establish a long-term relationship with A Ltd. Therefore, the following terms were laid down. The purchase price of the goods before any rebates or discount is 690,000, including VAT, levied at 15%. ALTD will receive a 10% volume rebate on the purchase price of the goods. And also LTD will receive a further 10% settlement discount if the outstanding amount is settled within 30 days. Now, required, determine the cost to be recognized as inventory. Okay, so in other words, let us calculate the initial cost of this inventory in LTD or ALTD's book. So always have to bear in mind the guidelines as the IS2 on the initial cost of inventory. So the initial cost should include the purchase price, but this purchase price, then we must adjust for it. If there's any taxes, that is non-refundable. Any import duties, discount, be it cash or trade or settlement, must take it into consideration. And also, very important, if there's any cost that was incurred to bring this inventory in its present condition and location, should also form part of the initial cost. Now, if we look at this example, you will notice that we only have the purchase price that will be capitalized as the initial cost of this inventory. Okay, how do we know that? Simply because we are told about the rebates, VAT, volume. We're not given any other cost that is directly attributable in bringing this inventory to its present location. Therefore, just the purchase price. But this purchase price, we must not just take it the way it is and then say that this is the cost or this is the initial cost of this inventory. No. So we write the purchase price of this inventory before any rebates or discount, which is 690,000. Now, this 690,000, we must calculate out the VAT. In other words, we remove the VAT. To simply do it, just take 100 over 115, then you multiply it by the purchase price. We'll get that to be 600,000. So the 600,000 is VAT exclusive. So there is no VAT in this amount. Okay, we removed the 15% VAT simply because this entity is a VAT vendor. Therefore, their VAT shouldn't form part of the cost of the inventory. Simply because they can refund this VAT anytime. Okay, and ALTD will receive 10% volume rebate on the purchase price of the goods. Okay, the 10% rebate, like we mentioned, rebate reduces the purchase price of the inventory. So which means we must not capitalize the entire 600,000, but instead we should calculate out this rebate of 10% Then calculated the rebate. So we just do the mathematics. So the easiest way to do that, you can just say times 10%, then you get the rebate, 600,000 times 10%, then that is 60,000. So we further have to calculate out the settlement discount of 10%. That is to now take the 100,000, we less out the rebate, and then we're balancing on 540,000. Then we're not going to capitalize the entire 540,000 simply because this entity was granted a 10% settlement discount if they'll have to settle within 30 days. So probably this entity will have to take use of this discount. Therefore, we have to take this amount and then multiply it by 10%. So we'll get 54,000 as our settlement discount. Settlement discount. Okay. So the cost that will be capitalized to this inventory is the initial cost will then be 600,000 minus the rebate. Let us say that way. You just take the 540 minus the 54,000, which will then have to be 540, which is going to be now 540 minus 54. That's going to be 486,000. So 486,000 will then be the cost that will have to be capitalized to this inventory as the initial cost. Okay. Example 3, we are told that X Ltd sells shoes which it buys from B Ltd at 300 per pair. B Ltd has agreed to grant X Ltd a rebate of 2% on all purchases if Ltd buys at least 200 pairs during a period of 12 months. The rebate will be settled in cash at the end of the 12-month period. Now, what is the purchase price? So normally, what is the purchase price? That will be recognized as part of the initial cost. Okay. Now, if based on the experience, it's likely that X Ltd will meet the 200 pairs target. Each pair of shoes should be recognized at a cost of 294. That is only if they will likely take advantage of that. They will likely have to buy, they will likely buy 200 pairs. Then that rebate will be granted. And what will happen now is that 2% rebate should be removed from the cost of this inventory on the date of purchase. That is only if likely this entity will take advantage or will have to buy, or will buy 200 pairs. Then that discount or that rebate, yes, should be calculated out on that day. With a receivable of $6 being recognized for the anticipated rebate. Okay, so $6 then should be recognized for the anticipated rebate, but very important, 294 will be the cost to be recognized or to be capitalized as inventory. So if it's not probable that 200 pairs target will be reached, then they'll have to recognize it at the amount of 300 deferred settlement terms. Now, IS2 is guiding us that if inventory is purchased on deferred settlement terms and the effect of financing is considered material, we have to discount future cash flows back to a present value, which will be taken as the cost. So in other words, deferred settlement terms, when the business buys inventory today and will only be able to pay for this inventory in the future periods. Now, as per IS2, what you have to do is that if the effect of financing is considered material, we have to discount the amount that the business will pay in the future back to present value. And that present value should be the amount to be considered as cost of inventory. Let's say the business buys inventory today, and then they'll pay for this inventory in 3 years' time, and they'll pay 50,000. Now, if the effect of financing is considered material here, then what we have to do is we need to discount this amount back to its present value. Okay, so we discount it back to its present value, and the amount we'll get, then that is the amount that will be regarded as the cost of inventory. Then IS2 still continues to guide us that the difference between this present value and the amount actually paid is interest over the period of financing. Now, still using the same example, so 50,000 will be paid in the future, let's say after 3 years. Therefore, if we discount this amount, let us assume if we discount it based on the present value of money, let us assume it will be 30,000 today. Now, as per IS2, the 30,000 is the present value, and that is the value to recognize as the cost of inventory. Now, the difference between this 30,000 and the 50,000 should be recognized as interest over the 3 years period. Okay. Let's look at this example. We are told that A Ltd recently incorporated and registered for VAT. A Ltd purchased goods on 1 Jan 2001 from a supplier who wants to establish a long-term relationship with A Ltd. Therefore, the following terms were laid down. So, first one is the purchase price of these goods is 6,957.50, including VAT. And also, we're told that A Ltd will pay for the goods on 31st December 2002. The market-related interest rate is 10% per annum. Now, required A is to show the journal entries assuming the effect of time value of money considered material. In other words, we must show the journal entries assuming that the effect of financing is regarded as not material. Yes, not material. Okay. But here, the effect of time value of money or financing is regarded as material. Now we should show journal entries on how we should account for it if the effect of financing is not regarded material, and also here regarded material. Now, if you look at what we're given here, you will notice that A Ltd purchased this inventory on 1 Jan 2001, but they did not pay for this inventory on 2001, but they will only be able to pay for this inventory on 31st December 2002. So, in other words, they were able to pay for this inventory in 2 years' time, because from 1 Jan 2001 to 31st December 2002, that's like 2 years. Okay. And the market-related interest is this one. We are required then to show that, or to show the journal entries if the effect of time value of money is not regarded material. How will the journal entries look like? Now, the other thing that you should not ignore in this statement is that this firm is a VAT vendor. It's registered for VAT. Therefore, their VAT will not form part of the cost of inventory as per IS 2. Okay, this amount that's given here, there is VAT included in it of 15,000. Okay, as per IS 2, that VAT will then have to be removed out. Now, let us look at the first journal entries. If the effect of time value of money is not considered material. On 1 Jan 2001, when the business purchased inventory, we're going to debit inventory, and the amount of purchase, we take that amount the business will pay in 2 years' time, and we multiply it by 100 over 115. That is the VAT amount in, so that we can get rid of the VAT, and we'll have 6,050 as our cost of inventory. Okay, the debit inventory, of course, and VAT input, that is the VAT amount now. So the VAT amount, if you wish to calculate it, you can calculate it this way. Take the amount and multiply it by 15 over 115. Then you get the VAT of 907.50 cents. Now, trade payable, have to credit it, and have to credit it with the full amount, including the VAT amount. So, you credit trade payable or creditor, then your narration, if required, then you say then be purchased on credit. At the end of year 2, that is on 31st December 2002. We have to derecognize trade payable when this amount will be settled off. Derecognize trade payable by debiting trade payable, and then since payments are being done, we credit bank. Okay, when the creditor will be paid off. Okay, we derecognize creditors or trade payable, and we credit bank. If we look at this, the effect of financing wasn't considered material. Okay, our journal entries will be like this. So we just have to remove the VAT from this amount, and then the answer we get is what we capitalize to the cost of inventory. Okay. And at the end of year 2, the creditor or the trade payable will be paid back. Then we have to recognize that, and that's it. Let us look at in times whereby the effect of financing is considered material. Okay. And yes, requirement B. So under requirement B, we should prepare journal entries to show the effect of time value of money if it's considered material. Okay, if it's considered material, then what we have to do first is to discount that amount, which is this amount here, the fair value, based on the present value. Okay, so to do that, you can, if you're having a financial calculator, just punch it and then you look for the present value. But now, if you're not having, you can use this formula here. Take 1/1 plus the interest rate, which is 10%, and the number of years. The power of the number of years. Okay, power of the number of years. So I take 1/(1) plus 0.10 with the interest rate, then to the power of the number of years. Okay, then you get the present value, which will be this one here. So this amount is a discounted amount based on the present value of money. It was discounted and we get this amount. So on 1 Jan 2001, we have to credit trade payable with the discounted amount of 5,750. VAT input should be calculated exact same way as in requirement A, which you're gonna get is 907.5. So the balancing figure will then be the amount to be capitalized to the cost of inventory. Okay, you can, if you look at this journal here, you will clearly notice that what we did is that we took this amount and then we discounted it back on its present value. Why did we do that? Simply because this is the amount that the entity will pay for this inventory in 2 years' time. Therefore, we needed to get that amount or the value of that amount today. In doing so, we had to discount it based on the present value of money using the discount factor or rate, which is 10%, And very important, the number of years should be considered. And we got this amount here. After doing that, we're supposed to capitalize this amount, this amount to the cost of inventory. But simply because this entity is a VAT vendor, we needed to remove that VAT, and the balancing figure then be capitalized as cost of inventory on 1 Jan 2001. Okay, so as per IS2, we're still being guided that over the period, in this case, over the 2 years period, and the difference between this amount and the actual amount that will be paid by the entity at the end of year 2 should be regarded as interest expense. Okay. So at the end of year 1, that is the 31st December 2001, we debit interest expense. Just take this amount, then multiply it by the 10% and get the interest. Then at the end of 31st December 2002, debit interest and then still have to credit trade payable. So we take this amount plus this amount, we get this amount and multiply it by 10%, you should get interest of 632.50. We credit trade payable, and at the end of year 2, that is on 31st December now, we have to derecognize trade payable by debiting trade payable with this amount and the payment to be done, credit bank. So you can see that if the effect of financing is considered material, we do not have to include the entire cost of this inventory as part of the cost of inventory. No. I mean, we don't have to include the entire amount paid for this inventory as the cost of inventory. Yes. So what we have to do then is to discount the amount that the business will pay in the future based on the present value, and the difference between that amount should then be regarded as interest expense. Okay. So conversion costs. Manufacturing or processing costs, including normal spillages that relate to conversion of raw materials into finished goods. Okay, like we mentioned earlier on, conversion costs, these are the costs that the business incur as it converts raw materials into finished goods. So very important, it includes direct costs such as direct labor. That's why now we have the salary, fringe benefit, pension, each for the labor that is directly involved in the production process. And also we have direct materials. Okay. Okay, not only direct costs involved when when we incur conversion costs, not only direct costs involved, but also we have indirect costs. Okay. We also have indirect costs. So the conversion costs and includes direct costs and indirect costs. So very important now is on the indirect costs. So focus more on the indirect costs. Because on the indirect costs, that's where now we have variable and fixed manufacturing costs. In other words, that's where we have variable and fixed manufacturing overheads. Okay. Now with the variable overheads, is very simple. They normally vary with production. They do vary with production, volume such as indirect materials. So if you want to produce more, for instance, if there's any indirect material that's needed in the production, such as water consumption, if you are using something, if you are producing something and it requires you water, then the more you produce, the more water you use. Okay, electricity varies based on actually use of production resources. So one of the indirect variable overhead is electricity. The more you like to produce, the more electricity you have to use. But we have fixed manufacturing or fixed production overheads. So this one do not vary with production volume, such as factory rental, salaries of supervisors, insurance of land and depreciation, and should be allocated to inventory based on normal capacity of production. Okay, so very important. IS2 is guiding us that in times whereby we have conversion costs, which includes direct costs and indirect costs. So what we have to do in terms of indirect costs whereby we have fixed manufacturing costs, which are the costs that do not vary with production. Okay. These costs do not vary with production, such as rental of a factory or salary paid to supervisors. Okay. Now, IS2 is guiding us that if we do have fixed manufacturing overheads, we should allocate these overheads to inventory based on normal capacity of production. Okay, we have to allocate the fixed manufacturing overhead to inventory based on normal capacity of production. So IS2 is still guiding us that in terms of low production, use fixed cost per unit based on normal capacity. The difference is then charged as cost of sales. Okay. And also in periods of high productivity, decrease the fixed cost per unit based on actual production. Okay. To break this one down, what we have to do is, in terms of low production, that is to say now that the business doesn't meet their normal production capacity. So what we have to do in that case, we must calculate the fixed cost per unit based on the normal capacity. Okay, and that is the amount we need to charge to inventory, and then the rest of the difference should be regarded as cost of sales. Now, in periods of high productivity, that is a period when the business now produces more than the normal capacity. So what we have to do in that case is that we must calculate the fixed cost per unit based on the actual production. So if we do that, what will happen then? There will be a decrease in the fixed cost per unit. Let's look at an example on this. Example 5. Example 5. Assume that fixed production overheads amount to 100,000 Namibian dollars. a normal capacity equals to 10,000 units, and allocate fixed overheads if actual production during the year amounted to, in A, that is 7,000 units. In B, that is 12,500 units. So we have to allocate the production or the fixed production overheads to production or to inventory. So how do you then do that? Okay, in case A, if you look at case A, you'll notice that the production here is only 7,000. But the normal capacity or the normal production capacity for the entity is 10,000 units. But in A, they only produced 7,000. Now, as per IS2, to get the amount we're going to allocate to inventory, since in this case, the production was low, we should take this amount and then divide it by the normal capacity production. Okay. Now, in B, the production was actually more than the normal production. As per IS2, to allocate fixed production overhead, what you have to do then is to take this overhead amount and we divide by the actual production. Okay, look at the solution. So what you need to get first is the allocation rate. Since in situation A, what happened is that 7,000 units were produced. 7,000 units were produced, which was actually lower than the normal production. Therefore, in that case, our allocation rate, we take the total fixed manufacturing overheads, we divide by normal production units or normal number of units produced. So the allocation rate will then be $10, 10 Namibian dollars per unit. Okay. So after that, to get the amount of fixed manufacturing overhead that will be allocated to inventory, you have to take this $10 and multiply it by by actual production, which is 7,000. So you notice that the amount we're gonna get here is 70,000. That is to say now that the 70,000 is the amount that the business will allocate to inventory. 70,000. Okay. If you look at the total fixed manufacturing overhead, you'll notice that is 100,000 Namibian dollars. But in this case, the amount we're going to allocate to inventory is only 70,000 Namibian dollars. Now, IS2 guides us that the difference between the two amounts, the one that will be allocated to inventory and this one here, then has to be regarded as, that 30,000 has to be regarded as an expense. Okay, so it will be expense, cost of sales. It will be expense, cost of sales. Okay, now in situation B, in B, to get the allocation rate, since there was high productivity, we have to take the total manufacturing overheads and then we divide by the actual production capacity. We then have to get $8 per unit. $8 per unit, that is our fixed cost per unit. So that is our allocation rate, in other words. So to get the amount of fixed manufacturing overhead allocated to production, what we have to do then is you take the actual production, then multiply by this amount. In that case, we get 100,000. So 100,000 will then be allocated to inventory. Okay, that is to say that the entire 100,000 will be allocated to inventory in cases of higher productivity. So the following costs have to be excluded. Okay, so IS2 guides us that we must exclude these costs. Abnormal amounts of waste incurred in the production process. Okay, so if there's any abnormal amount of waste incurred in the production process, then that amount should not form part of our inventory. Okay. Impairment losses on machinery and equipment used in manufacturing process, then that amount should not form part of the cost of our inventory. Labor costs during strikes and abnormal machine breakdowns, they should never form part of our inventory. Okay. Now, costs to distribute and transport goods to customers should never form part of the cost of inventory. Selling expenses, advertising costs, general administration overheads, and storage costs should never form part of the cost of inventory unless relating directly to production. Okay. The storage cost, if it relates it relates directly to production, then it will form part of the cost of inventory. Okay, but if it doesn't, let's say this storage cost is just to store finished goods, then in that case, it should not form part of the cost of inventory. Okay, and if to store the materials or raw materials that the business will use, then such storage costs should be capitalized to cost of inventory. Okay, example 6. We are told that X Ltd employs 10 factory workers at a rate of $15 or 15 Namibian dollar per hour. These employees were on strike for one entire month, during which production ceased completely. After negotiations with the trade union, X Ltd agreed to pay these workers an amount of 15,000 Namibian dollar for the month during which they were on strike. Okay. The total wage bills in respect of these employees amounted to 280,000 Namibian dollar for the year. Now, the question is, how much of labor costs should be included in inventory cost? Okay. So if you look at this example, you will notice that X Ltd is a manufacturing entity. It's a manufacturing entity, and they do use 10 workers, and they pay these workers at $15 per hour. So what happens as these employees were on strike? Okay, were on strike. So production did not take place during that period as these employees were on strike. But since the negotiation were in favor of the employees, and what happened is that these employees were paid an amount of 15,000 during, in respect of the month they were on strike. You see? So in total, the amount paid to these employees during that year was this amount. Now the question is, should we include this amount, the entire of this amount, as cost of inventory for this manufacturing entity? Must we include this as the cost of inventory? So the answer is no. The reason being is because as per IS2, if the employees were on strike and they were paid an amount, that amount should not form part of the cost of inventory. Therefore, we take the total amount paid during the year, we less that amount that these employees were paid during, in respect of that month. Okay. And that is we less than 265,000 Namibian dollar or 265,000 Namibian dollar will be capitalized, or it will be the amount of labor cost to be capitalized to the cost of inventory. Okay, now let us look at the subsequent measurement of inventory. Okay, let us look at the subsequent measurement of inventory. So inventory is measured at the lower of cost or net realizable value. Okay, which means that in the subsequent years, the business must measure inventory at the lower of cost or the net realizable value. That is to say, now if the cost is 50 and the net realizable value is 40, this inventory should be measured at 40. Okay, if future net revenue expected to be generated by the sale of inventory on hand is less than the cost of that inventory, then the inventory should be written down. Okay. So IS2 is guiding us that if the revenue that is expected to be generated by the sale of the inventory on hand, if that revenue is less than the cost of that inventory, then that inventory should be written down. Okay, inventory should be written down. When you speak of inventory being written down, we mean to reduce the value of that inventory. Okay, so net realizable value is estimated as, by definition, is estimated selling price in the ordinary course of business less estimated cost of completion, estimated costs necessary to make the sale. Okay, that is the net realizable value. Okay. In other words, if you need, or if you want to get the net realizable value, you just have to take the estimated selling price for that inventory, then you less any cost of completion and cost required to make the sale. Okay, so expected future revenue should take into account cost of selling. So that is marketing costs, distribution costs, packaging costs, and sales commission. Those costs should be taken into account. And those are the costs that we mean by saying estimated cost of completion and estimated cost necessary to make the sale. Okay. So in times whereby inventory is damaged, obsolete, selling prices have declined, estimated cost to make the sale will increase, okay? Or to estimated cost of completion have increased, then that inventory should be written down. Okay, so to say, if inventory is damaged, obsolete, and the selling prices have declined, what we have to do is we have to write down the inventory. That is to reduce the value of the inventory. Our inventory should be written down on an item by item basis, but however, grouping of items that relate to the same product line, same purpose, marketed in a similar geographical area, and cannot be practically evaluated separately is also allowed as per IS2. Okay, so estimates on the net realizable value are based on evidence at year end. Okay, now let's look at this example. Inventory with a cost of 200 per unit will be sold at a price of 180 Namibian dollar per unit in terms of an existing contract. Similar products are selling at 210 Namibian dollar per unit in the open market. The contract requires delivery of 10,000 units. At year end, the company had 10,100 units on hand. Required, calculate the carrying amount of the inventory. Okay, so to calculate the carrying amount for this inventory, if we look at the contracted inventory, if we look at this contract here, require the business to deliver, require the business to deliver 10,000 units. So the 10,000 units, as per agreement, should be sold at 180. So the amount is 1.8 million. But also need to look at the excess inventory here. As we're told that the inventory cost is 200 per unit. So we have to take the 200, take the 200 and then multiply it by the 100. Okay, because the 100 is resulting from this amount of inventory at hand minus the amount of inventory required to be delivered. So that is 100. So we multiply it by 200, get 20,000. Then the total carrying amount in this case will be this amount here. That is, take this amount plus this, and we get 1,820,000 Namibian dollars as our carrying amount for this inventory. Okay. So, very important, reversal of write-downs. If inventory was previously written down, we have to reverse that. if inventory was written down in prior years for year and still on hand at year end, and the circumstances that led to the write down have now reversed, then the previous write down may be reversed. Write downs may reversed limited to the amount of the original write down. The carrying amount may be increased back up to cost, but not above the cost. Okay, so IS2 is guiding us at in times whereby inventory that was written down in prior year is still on hand, and we find out that there are some circumstances leading to that inventory written down being reversed. So what we have to do is that we must have reversal of write downs. We must reverse the write down of that inventory, but we are limited. We are limited to the amount of the original write down. Okay. So the carrying amount, in other words, the carrying amount may be increased back up to the cost, but not above the cost. Okay, inventory measurements. Okay. IS2, as per IS2, we have first in, first out. Okay, as our inventory measurement. So first in, first out, normally used where items are interchangeable, goods produced, purchased, first are sold, first. Okay, that is to say now that first in, first out is the good that was bought first should be the first good to be sold out. Okay, so they are normally used for items that are almost the same and can be used or sold in place of each other, what you call as interchangeable items. Okay, the inventory that came in first or the good that came in first in the business should be the first good to be sold out. Okay, now let us look at this example. On 1 Jan 2001, LTD buys 1,000 units of product X at $10 per unit. At 1 Feb 2001, the company buys another 500 units of product X at $12 per unit. At 31st December, year end, 600 units of product X were on hand. Okay, so we are asked to calculate the value of closing inventory. Okay, using this inventory valuation or measurement, first in, first out. So we should calculate the closing inventory. Okay. To do that or to calculate the value of the closing inventory, this is what we need to do. So the inventory that on hand were 600 units. The inventory that on hand were 600 units. Okay. Now let us look at how the movement in this inventory was. On this day, 1,000 units came in, which means all of these inventory were sold out. No, only 900 units were sold out. It will. Of this inventory, only 900 were sold out. So which means that 100 units were not sold out. So it's still in the business. Okay. That is to say now that the 600 units that were still on hand resulted from these 500 units that came in the business on 1st September, and the other 100, which is making up to 600, is coming from this inventory. Okay. Now to calculate the value of this inventory, what you have to do then is take the 100 units and multiply it by this amount here, which is $10. And we add the 500. Remember, 600 units, okay, on hand. So the 100 is coming from this inventory that was purchased at $10. And we multiply it by these 500 units. They were $12 per unit. So let's use Namibian dollar, $12, and then the answer we're gonna get, that is the value for the 600 units. So that is the value of this closing inventory. Okay, so that will be 7,000 Namibian dollars. Okay, so it will be 7,000 Namibian dollars. Okay, so continuing, we also have the weighted average measurement. So the same also used where items are interchangeable. Cost of item is determined from the weighted average of the cost of similar items at the start of the period and cost of similar items purchased or produced during the period. Average calculated on a periodic basis, be it monthly or when each new shipment is received. Okay, in a nutshell, the weighted average method of inventory measurement focuses on the average value of the inventory at certain day. Okay, which means, or in other words, you can still say with the weighted average method, inventory is sold out based on the average cost for that inventory. Okay, and you also have the last in and last out method, but IS2 does not include that method. So IS2 only includes the first in and the first out method and the weighted average method. Okay, let's look at this example. On 1 Jan 2001, LTD buys 1,000 units of product X at $10 per unit. 1 September, okay, so the same example like the one we did, the previous example. So they had 600 units of product X on hand. So the question is, what is the value of the closing inventory? Okay, so to get the closing or the value of the closing inventory, what you have to do is to get the average cost for the inventory that's in the business. So we must get the average cost for the inventory that's in the business at the end of the period. To do that, if we look at this inventory that came in, 1,000 units. And also inventory came in at, of 500 units. Okay, so we can take it from there first to get the average cost. That is to now take the total cost for this inventory, which is 1,000 times $10. That is 10,000. So 1,000 plus 10, 1,000 times $10, that is 10,000. And 500 times 12, that is 6,000. So the total cost then is 16,000. Okay, we divide it by the total number of inventory that came in, which is 1,000 plus 500, that is 1.5 units. So yes, the total cost for this inventory is 16,000, and the total number of units is 1.5. Therefore, the average cost for this inventory is $10.67 per unit. Okay, having done that, to get the value of the closing inventory, just take the closing inventory at the end of the period, which is 600 units, multiply by the average cost. Okay, so multiply by the average cost, that will then be this amount. So this amount, which is 6,402, will be the value of closing inventory. Okay, so that is the weighted average method of inventory measurement as per IS 2. Inventory systems. So the movement of inventories, be it purchase on, and sell, can be accounted for in different ways. Okay. So inventory movement can be accounted in different ways. The first system is what we call as a virtual system. This one has to do with the counting of movements as and when they happen. Okay. We perpetually update our ledger accounts for inventory purchased and inventory sold. So with this system, the inventory account will always be up today. Okay, in other words, this system, the one that updates our inventory all the time. Every time we buy or sell inventory, the system records it immediately. So it's great for real-time tracking, and you can always know what you have as inventory or at hand. Okay, so this method, it's good, especially if you have good software or detailed records, then it's best to use this method. We also have periodic system. This one has to do with the counting of inventory on hand periodically, as at year end, at a specific point in time, commonly used by small businesses with no computerized accounting systems. We update our ledger accounts for inventory purchases. We do not update it for the inventory sold. Okay. So periodic system, we don't update the inventory every day. Okay, instead, you have to wait until at the end of the period or at a certain or a specific period, be it month. Okay, that's the time now. You have to count the inventory and update the records. Okay, so we update our ledger accounts for inventory. We do not update it for inventory sold. Only update for the purchase of inventory, but not for inventory sold. Okay, that's why now we need to calculate cost of sales. That's why now it requires us to calculate cost of sales by taking the open inventory plus the purchases, carriage inwards, less the closing inventory in order for us to get the cost of inventory sold. Okay. This then bring us to the end of IS2 inventories. In the next tutorial, we'll look at a practical example on IS2. Okay, so do not forget to subscribe, like, and comment. See you in the next tutorial. Bye-bye.